For years, we were told rents only go up and that waiting would mean getting priced out forever. But in 2026, that script has flipped completely. The era of outrageous fees and hefty deposits is quickly fading. In several cities, a flood of new apartments has collided with an affordability crisis, pushing renters to double up or move back home. Now, major investors who bet on endless growth are stuck with empty units and forced to offer major concessions just to stay afloat. We're taking a cross-country look at the 10 cities where rents aren't just cooling, they're falling fast. Some were recent boomtowns. Today, they're cautionary tales. Stay with me through number 1, where the downturn is being compared to 2008. But this time, landlords are feeling the hit. If you appreciate real data over headlines, like the video, subscribe for more updates and tell me which city you think is still overpriced. Let's hit the road and see where rents are dropping the hardest. Number 10. Nashville, Tennessee. When you pull into Nashville, better known as Nashville, you probably expect the usual scene: pedal taverns rolling by, packed honky-tonks, and non-stop bachelorette parties lighting up the weekend. But if you shift your focus to the skyline, a different story starts to unfold. For the past several years, cranes filled the horizon, signaling non-stop construction. Now those cranes are gone, their projects complete. And what they've left behind is a serious headache for property owners. The city is now flooded with upscale 2-bedroom units priced far beyond what most renters can realistically afford. Recent figures out of Tennessee paint a stark picture. According to Apartment List, year-over-year rent growth has slipped deep into negative territory, dropping by nearly 6%. At the same time, vacancy rates in the downtown area have surged to levels not seen in roughly 10 years, hovering around 13% based on data from the local real estate board. And the incentives landlords are offering tell you everything you need to know. Data from Zillow shows that nearly 45% of active listings in Nashville now include at least 1 month of free rent just to attract a signed lease. Meanwhile, a study released by the Greater Nashville Apartment Association reveals that the total apartment supply has jumped by 22% in only 2 years. That surge has dramatically outpaced population growth, which has cooled off considerably. Adding to the pressure, RealPage reports that effective rents for new move-ins have fallen by about $150 per month compared to their peak in 2023. You can feel the anxiety among landlords, especially those who finance their purchases with adjustable-rate loans, banking on steady rent increases to offset rising interest costs. Instead of higher revenues, they're dealing with Class A buildings, struggling to maintain even 85% occupancy. Take a walk through neighborhoods like the Gulch or Germantown, and you'll see now leasing banners stretched across building after building, a quiet signal of just how competitive things have become. Nashville positioned itself as the next big destination for tech, entertainment, and culture. The problem is, developers moved too aggressively, building too many high-end units too quickly and at price points the market simply couldn't sustain. For renters, this shift means leverage. Deals are back on the table. Number 9. Phoenix, Arizona. As you leave Tennessee behind and head west, you eventually roll into the blazing desert landscape of Phoenix. These days, though, the scorching heat is about the only thing climbing. Not long ago, Phoenix was the ultimate symbol of the pandemic relocation frenzy, drawing in waves of newcomers from California, New York, and beyond, all chasing sunshine and a lower cost of living. But that migration surge has reversed course, and it hasn't been subtle. The local rental market is now experiencing one of the steepest downturns anywhere in the western United States. Fresh numbers from Redfin show that asking rents across the Phoenix metro area have fallen by nearly 7% compared to this time last year. Meanwhile, developers never took their foot off the gas. According to CoStar Group, more than 32,000 new multifamily units were completed in just the past year, the highest annual total the region has ever seen. That flood of new apartments has driven the vacancy rate up to nearly 10%, a number that's enough to make any landlord uneasy. It's not just large apartment operators feeling the squeeze. Investors who snapped up single-family homes to convert into rentals are also under pressure. The Cromford report highlights a 30% jump in active rental listings for single-family properties alone. The issue isn't only oversupply, it's affordability. Wages simply haven't kept pace with the rent spikes of recent years. Data from the Bureau of Labor Statistics shows that while rents have roughly doubled over the past 7 years, local incomes have increased by only about 35%. That mismatch has created a hard affordability ceiling, and Phoenix appears to have slammed into it. Further research from Apartment List indicates that the city has endured 18 straight months of either flat or declining rents, suggesting this isn't a quick correction, but a prolonged slowdown. Drive through neighborhoods like Scottsdale or Mesa, and you'll spot "for rent" signs lingering for 2 or even 3 months at a time. Individual landlords now find themselves competing with massive corporate complexes offering aggressive perks: 3 months of free rent, complimentary parking, and other incentives just to fill empty units. The once sky-high confidence that defined the Phoenix housing boom has all but disappeared. In its place is a market where renters can negotiate pricing, concessions, and lease terms with surprising leverage. It's a powerful reminder that in the desert, scarcity defines everything. And at this moment, the rarest commodity in Phoenix is a tenant willing to pay peak 2022 prices. Number 8. Jacksonville, Florida. As you head southeast toward the Atlantic coast, you land in Jacksonville, a city once marketed as the budget-friendly alternative to Miami and Tampa. For years, Jacksonville attracted investors with promises of reliable rental income and rapid population growth that seemed almost guaranteed. But in 2026, that optimism has run headfirst into reality. The local rental market is buckling under a combination of soaring insurance costs and a wave of excess inventory that few speculators saw coming. Recent figures from Zumper show that the median rent for a one-bedroom apartment has dropped 8.4% over the past year alone, a steep decline by any standard. What makes the situation worse is the heavy presence of institutional investors. Large firms purchase thousands of single-family homes to operate as rentals, and now many of them are scrambling either to fill vacancies or unload properties at the same time. Data from the Northeast Florida Association of Realtors reveals that single-family rental inventory has surged by 40%, partly because homeowners who can't sell in today's softer market have decided to rent instead. According to Realtor.com, Jacksonville ranks among the highest in the nation for rental price cuts, with roughly 1 out of every 3 listings reducing its asking price within the first month. Another troubling indicator comes from the United States Census Bureau, which reports that net migration into the area has slowed significantly, undermining the aggressive growth forecast developers once relied on. On top of that, insurance premiums have surged. Local reports suggest costs are up around 30%, and unlike in previous years, landlords are discovering they can't simply pass those increases onto tenants in the form of higher rent. Analytics from RealPage show lease renewal rates have slipped to about 50%. In practical terms, that means half of renters are choosing to move out in search of more affordable options, rather than renewing at current prices. That level of turnover is expensive. Every vacancy means repair bills, cleaning costs, and new marketing expenses, all while revenue is shrinking. Drive through neighborhoods like Riverside or San Marco, and the abundance of "for rent" signs makes the oversupply impossible to ignore. Number 7. Las Vegas, Nevada. Next stop, Las Vegas. The glowing oasis in the Mojave Desert where the casino usually takes the pot. This time, though, it's the landlords who are coming up short. Vegas has always thrived on dramatic highs and painful lows, and right now the rental market is deep in one of those downturns. A cooling economy combined with shifting dynamics in the tourism sector has spilled over into housing, dragging rental prices down with it. The Las Vegas Realtors reports that vacant rental homes have climbed to a 5-year high, intensifying competition among property owners desperate to fill units. Data from Rent.com shows average rents have fallen about 5.5% compared to last year, effectively erasing nearly all of the growth landlords celebrated over the previous 2 years. Employment conditions aren't helping. According to the Bureau of Labor Statistics, Nevada's unemployment rate remains above 5%, ranking among the highest in the country and putting serious pressure on tenants' ability to afford premium rents. Evictions are also climbing. Research from the Princeton Eviction Lab indicates that filings in Clark County have jumped by 25%, leaving landlords with unpaid balances and vacant properties. Compounding the issue, large Wall Street investment firms own a significant share of local housing inventory. Figures from Redfin suggest these institutional owners are beginning to liquidate properties or sharply discount rents just to keep occupancy levels stable. And despite weakening demand, supply keeps growing. CoStar Group projects that another 7,000 apartment units will hit the market this year alone. You can stroll down the Las Vegas Strip and still see the spectacle, the lights, the illusion of endless prosperity. But drive 10 minutes into suburban communities like Summerlin or Henderson, and the tension in the rental market becomes obvious. Apartment operators are now dangling incentives that would have sounded absurd not long ago. Complimentary moving services, generous gift cards worth thousands of dollars, and extended free rent offers. The gamble investors made, assuming they could charge California-level rents in Nevada, has backfired in dramatic fashion. Las Vegas is once again reminding everyone that it's a market defined by volatility. And for landlords who expected steady returns instead of sharp swings, the cards they're holding right now are anything but a winning hand. Number 6. Portland, Oregon. Heading up into the Pacific Northwest, you arrive in Portland, a city where the rental downturn isn't just about economics, but a complicated mix of social challenges and shifting migration patterns. In recent years, Portland has experienced a noticeable outflow of both residents and businesses, and that departure has carved out a sizable gap in rental demand. As more people relocate elsewhere, the imbalance between available units and qualified renters has widened, pushing prices lower at a rapid pace. Data from Multifamily Northwest shows downtown vacancy rates climbing to roughly 14%, leaving many high-rise apartment towers only partially occupied. According to Apartment List, rents have dropped 7.2% compared to last year, one of the sharpest declines anywhere along the West Coast. Figures from the United States Census Bureau confirm that Multnomah County has posted population losses for 3 consecutive years, shrinking the pool of potential tenants. On top of that, landlords are navigating a framework of strict local housing regulations. Still, the broader market appears to be exerting even more pressure than policy ever could, as falling rents adjust naturally to weaker demand. Statistics from Zillow reveal that close to 60% of rental listings now include concessions, a clear signal that property owners are struggling to secure signed leases. Meanwhile, development projects approved years ago are finally being completed. Reports from Metro indicate that thousands of additional units are coming online, further saturating an already soft market. Local surveys frequently cite safety concerns and rising living expenses as key drivers behind the population decline. As residents migrate outward to suburban areas, the urban core feels increasingly hollow. The weakness isn't confined to housing. A study from Colliers points to record-high office vacancy rates, reducing the need for workers to live near downtown job centers. Walk through neighborhoods like Pearl District, and you'll notice for lease signs appearing almost as often as cafes. Portland's landlords are confronting pressure from both directions, a declining population on one side and a glut of apartments on the other. Number 5. Atlanta, Georgia. Now we swing back down south to Atlanta, often called the capital of the New South, where the rental market is slowing down fast, almost like traffic slamming to a halt on the downtown connector at rush hour. During the pandemic years, Atlanta became a magnet for institutional money. Large investment firms poured in, snapping up entire neighborhoods in bulk, convinced that growth would be unstoppable. That playbook is now starting to fall apart. What the city is left with is an oversupply of luxury apartments that far outnumbers the wave of high-income renters developers were counting on. Data from RealPage shows Atlanta ranking among the top 5 U.S. cities for new apartment deliveries, with more than 20,000 units completed in just the past year. That surge in inventory has weighed heavily on pricing. According to Apartment List, rents have dropped 5.8% year over year, a sharp reversal from the rapid increases seen only a short time ago. The Atlanta Apartment Association reports that occupancy levels have slipped below 92%, a number that many large complexes consider the minimum needed to stay comfortably profitable. At the same time, eviction activity is climbing. The Federal Reserve Bank of Atlanta has recorded eviction filings running about 40% higher than pre-pandemic levels, adding even more instability to the market. This creates a tense environment where landlords are scrambling to secure qualified tenants, yet that pool of renters is getting thinner. Figures from Redfin show that in submarkets like Buckhead and Midtown, More than half of rental listings have reduced their asking price within the past 60 days. Another shift is happening beneath the surface. Renters are gravitating toward brand new buildings offering generous concessions, sometimes months of free rent, while older Class B and C properties are being left behind with rising vacancy. Meanwhile, the United States Census Bureau has documented a slowdown in net migration to the metro area, signaling that the explosive growth phase may be cooling off. The skyline tells the story. Sleek glass towers dominate the horizon, but at night, many of those windows stay dark because the units simply aren't filled. Atlanta's landlords are coming to terms with a hard truth. You can't charge New York-level rents in a market where wage growth hasn't kept up. Right now, the negotiating power has shifted decisively to renters, who can push for upgrades, discounted rates, and flexible lease terms in a way that would have been unthinkable just a couple of years ago. Number 4. Raleigh, North Carolina. A quick trip northeast brings you into Raleigh, right in the heart of the Research Triangle, a region once promoted as the East Coast's answer to Silicon Valley. For years, Raleigh was marketed as an unstoppable tech powerhouse, drawing ambitious development projects that now sit with now leasing banners rippling in the breeze. What went wrong? Developers chased optimistic headlines about tech expansion but underestimated the timing. They delivered thousands of new apartments just as the sector cooled, with layoffs and hiring freezes replacing the rapid growth everyone had expected. According to CoStar Group, Raleigh currently has one of the highest construction-to-inventory ratios in the country, with total apartment supply expanding nearly 8% in just 1 year. That surge has weighed heavily on pricing. Data from Apartment List shows rents falling 6.5% compared to last year. Meanwhile, Zillow reports that across the Raleigh-Durham area, the share of rental listings offering concessions has doubled over the past 2 years. Vacancy has climbed to around 11%, an eye-opening number for a market that felt nearly fully occupied not long ago. The Triangle Apartment Association notes that absorption rates, essentially how quickly new apartments get rented, have slowed by roughly 30%, a clear sign demand isn't keeping pace with supply. Investors who entered the market expecting double-digit appreciation are now dealing with negative cash flow instead. Figures from Redfin reveal that investor purchases in the area have plunged by 45%, suggesting many large buyers are stepping back. Drive along Glenwood Avenue or through North Hills, and you'll see aggressive marketing everywhere. Luxury buildings offering 2 months of free rent, waived amenity fees, and other incentives designed to lure renters away from competitors. The rivalry has grown so intense that property managers are effectively poaching from one another, fighting over the same limited tenant pool. Raleigh remains an attractive city with long-term potential, but for landlords navigating 2026, it's a difficult landscape marked by rising vacancies and shrinking income. Number 3. Boise, Idaho. Now we head back west, into the mountains, arriving in Boise, a city that for a while became the poster child of the pandemic housing frenzy. Boise's growth wasn't just fast, it was explosive, and by almost every measurable standard, it was unsustainable. What's happening now ranks among the most dramatic corrections in the country. At the height of the remote work boom, this was the go-to destination for people escaping expensive coastal metros. But once return-to-office mandates began rolling out and local home prices soared beyond reason, that migration wave came to an abrupt halt. The result? A city left holding far more housing than it has residents to occupy. Data from Apartment List shows that rents in Boise have fallen nearly 9% from their peak, one of the steepest pullbacks nationwide. Local MLS figures indicate rental inventory has tripled since 2022, largely because would-be sellers, now stuck with homes they can't offload at a profit, have turned into reluctant landlords. 2 years ago, analysis from the Wall Street Journal labeled Boise the most overvalued housing market in America. Today, that overvaluation is being corrected in real time. Vacancy rates have climbed past 10%, a stunning shift for a city that not long ago had virtually no available units. According to Zumper, the average rent for a 2-bedroom apartment has dropped by more than $200 per month compared to last year. Compounding the issue, building permits for new multifamily developments hit record highs just before demand cooled, meaning additional supply is still coming online, even as the market softens. There's also a clear income mismatch. Local wage data shows that residents simply cannot sustain the rent levels that incoming Californians were briefly willing to pay. Now that those out-of-state buyers and renters have largely stopped arriving, prices are being forced to realign with local earning power. Walk through neighborhoods like North End or downtown Boise, and you'll notice the sheer volume of for rent signs, a visible sign of landlord urgency. Property owners are feeling pressure from both sides, declining rental income paired with falling property values. It's a painful combination. Number 2, San Francisco, California. Finally, you make it all the way to the Pacific and arrive in San Francisco, a city that once held the undisputed title for the most expensive real estate in the country. What's happening here isn't just a temporary dip. It's a structural reset that's reshaping the market in ways that could last for years. A large-scale tech exodus, the normalization of remote work, and ongoing concerns about urban living have fundamentally weakened rental demand. Few people anticipated just how sharp this shift would be. Yes, San Francisco is still pricey compared to most of America, but when you measure current rents against their peak, the drop is striking. According to Zumper, rents remain nearly 15% below their pre-pandemic highs. And unlike many other major metros, they've struggled to fully rebound. The commercial side tells a similar story. CBRE reports that office vacancy rates are hovering around 35%. With so many desks empty, far fewer workers feel compelled to live near downtown. Coverage from the San Francisco Chronicle suggests thousands of rental units are effectively sitting idle as shadow inventory. Some landlords would rather keep apartments off the market than commit to long-term leases at today's lower, often rent-controlled rates. For properties that are actively listed, Apartment List shows pricing growth remaining flat or negative year over year, hardly a sign of recovery. Meanwhile, the United States Census Bureau confirms the city has lost more than 7% of its population since 2020, permanently shrinking the renter base by tens of thousands. In the luxury segment, the stress is even more obvious. Some high-end buildings are offering up to 12 weeks of free rent, an aggressive concession that signals real pressure at the top of the market. A report from the Hoover Institution notes that the departure of high-income residents has eroded both the city's tax base and the pool of tenants able to afford $4,000 monthly rents. Walk through neighborhoods like Soma or the Financial District, and you'll notice a different atmosphere. Quieter streets, less foot traffic, and leasing offices that feel far less busy than during the boom years. Owners who purchased at peak valuations are now confronting foreclosures or steep losses if they choose to sell. For decades, the assumption was that San Francisco would always rebound. That belief is being tested in a serious way. Number 1, Austin, Texas. At last, we reach the top spot, the ground zero of the 2026 rental downturn, Austin. Not long ago, Austin was crowned the hottest housing market in America. Today, it has become a case study in what happens when optimism turns into overbuilding. For landlords, this shift feels less like a slowdown and more like a full-blown crisis. During the boom years, developers operated under the assumption that demand would expand forever. Apartment projects broke ground at a relentless pace, as if new tenants would materialize endlessly. That assumption has proven wildly inaccurate. What's unfolding now is a tidal wave of supply, an overwhelming surge of new units that has saturated the market. Figures from Redfin and other national data sources show that asking rents in Austin have fallen by more than 10% compared to last year, marking the steepest drop in the country. According to RealPage, the city's apartment inventory has expanded by nearly 50% relative to just a few years ago. That kind of growth simply cannot be absorbed quickly, no matter how strong a market once appeared. Vacancy rates have climbed to roughly 14%, and with additional projects nearing completion, those numbers are expected to rise further as more keys are handed over. Institutional investors are responding by trimming exposure. Data from Parkle Labs points to a significant sell-off of single-family rental portfolios across the metro area. Meanwhile, Zillow reports that concessions are nearly universal. Many new developments are offering multiple months of free rent, complimentary parking, and waived security deposits just to attract applicants. The Austin Board of Realtors notes that active rental listings have reached record highs, creating a frozen environment where deals rarely close without meaningful price cuts. Hiring slowdowns from major employers, including Tesla and other technology firms, have further reduced the influx of high-income renters that once fueled the market's expansion. Drive through neighborhoods like East Austin or the Domain, and you'll see sleek, newly constructed apartment communities that look impressive by day, but noticeably underoccupied after dark. Landlords are facing intense pressure. With rental income in some cases down 20% to 30%, many are confronting refinancing challenges, urgent cash injections, or even foreclosure risks. This moment marks what many are calling the Great Austin Correction, a vivid reminder of how quickly real estate euphoria can reverse. If you're renting in Austin right now, approach any lease agreement strategically. Negotiate firmly. The leverage is squarely in your hands. And that brings our journey to a close. From the oversupplied towers of Nashville to the sharp declines in Austin, the pattern is unmistakable. Too much inventory, not enough qualified renters, and landlords scrambling to adapt. If you found this cross-country breakdown helpful, consider liking the video, sharing it with someone planning a move, and subscribing for more clear-eyed financial analysis. Drop a comment as well. Are you noticing similar rent reductions in your neighborhood?